Welcome back. Today I'm going to be talking about the 3 biggest mistakes that a new investor to investing in the stock market makes. However, I'm going to quickly run through the big news this week or my 3 top topics of the week. Firstly, Ocado overtakes the value of Tesco, which is £20 billion, to shortly then after being sold by a company named AutoStore, which is based in Norwegian, for using their patented technology as the foundation of Ocado's robot warehouses. Ocado actually responded to this allegation within 2 hours, and they're now investigating whether AutoStore are planning to infringe their patents. Ocado shares are about 5.81% down this week. If they fall further, I may potentially be buying some, as it is a quality company. It's just very highly valued. 7,500 UK jobs and 1.2 trillion pounds worth of assets are going to be moving from the UK to the EU over Brexit, and in fact have projected even further to be 75,000 UK finance jobs to also be removed abroad. This is because these financial firms have made various different estimations and projections that have so much variability, meaning that there's so many different possible outcomes. The way for them to remove this risk is to effectively move abroad, and therefore there is less of a risk to them. Especially with 90 days left of the year and subsequently very, very close to the Brexit deadline, it certainly puts a lot of pressure on these finance firms. And when you are as big and as diverse as that, you're certainly going to be wanting to minimize risk. As for the assets themselves, they're already owned by EU citizens and companies, and so they're not actually our assets, but we are losing some under management. The bonus news item is that Donald Trump is actually showing mild symptoms of the pandemic. Considering he is actually 74 years old as of this video, this could mean a lot for the stock market. Combined with the fact that the US elections are incoming very shortly, this could lead to a lot more volatility. And the saying goes, when the US sneezes, the whole world catches a cold. So we can expect some high market volatility to come in the last few months of the year. Lastly, Boohoo had announced their half-year results for their business, and I believe them to be very good. They'd announced that their revenue was up 45%, their gross profit was up 47%, and their adjusted diluted earnings per share was up 56%. This is incredible growth by Boohoo, and the share price actually fell. However, I believe the share price fell for some different reasons. Firstly, Shadowfall, the company that had originally shorted Boohoo back in May, had said on Twitter, "Oh, we are now shorting the business again." However, the only activity they post is based on Boohoo. If you were talking about Twitter, I'm also on there. If you would like to follow me at Ozbourne Foreman, I actually announced this earlier in the week and when it first came out. However, I feel that investors also expected higher results than what were provided, and therefore this was already priced in. This is combined with Boohoo also saying that they expect the full year growth results to be much less, being around 28 to 32%. So obviously they're being quite cautious around it, and therefore investor sentiment has lowered, which has led to Boohoo stock dropping 5.3% for this week. And if it drops to below 300 pence per share, I'm seriously considering the idea of picking up more shares. According to Google Finance, the FTSE 100 is up 0.79%, the FTSE 250 is up 1.81%, the S&P 500 is up 0.8%, and my portfolio is down 0.98%, making it the first week in roughly 5 weeks that I have underperformed the market. I'm really not surprised considering my high weighting towards Boohoo. Don't forget, coming next week is my 6-month review of the portfolio, so please consider subscribing, as it doesn't cost a penny and it is free so that you don't miss out. Regardless, my portfolio was very much dragged down by the change in investor sentiment of Boohoo, and I'm not worried in the slightest. I do believe that this sentiment will gradually start to build up, and historically on earnings dates this has happened. There was a short sell-off. I think as analyst ratings come and as funds potentially start investing in Boohoo, that this share price will start to increase over the long term. Even if currently Boohoo's share price is being manipulated, I suspect that this will not last too long. Regardless, if there is high volatility, I will be topping up. This week I've purchased 11 more shares of Softcat and received dividend income from Halma of £2.68. Since I started this channel, which was in April 2020, I also started stock picking. In the space of time, I would very much consider myself as a beginner investor. Therefore, I've either experienced these mistakes myself, or the friends that also invest have made these mistakes. I know that when I first started, I was very much interested in learning what other mistakes beginners made, so that I could learn from their mistakes and learn from others, and then use that to not make these mistakes myself. Also, please understand that I'm not trying to blow my own horn as the greatest investor ever to be on YouTube, because obviously that isn't true. Just remember that I am a lad on the internet that has a passion for talking about stocks, and that's it. I'm going to start this list by talking about a mistake that I had made myself at the start of my investment journey. And in fact, this actually combines a few mistakes into one. As I am adding bonus mistakes, please consider dropping one of these for the YouTube algorithm. In fact, I had made this mistake more than twice in the last year, especially when I had first started. I remember looking at Santander Asset Management, picking a high risk fund and investing in it. I remember I did not worry about how much money I put into this. The issue was not that I'd put such a significant amount of money into it, but rather the fact that I didn't even understand what my investments were. This fund, for all I could have known, could have been invested in purely unprofitable companies with low growth potential. Or even this fund could have had a 98% exposure to Wirecard prior to them going bankrupt. And so the share price could drop. I may think, yes, this is an excellent time to average down and top up. What I would be doing is investing in a bankrupt company. Therefore, this would simply mean that I would have no clue as to why this fund would be dropping in value, but rather just be writing it off as high risk. Since it's high risk, therefore, it is expected for this to potentially drop, but it must go up in the long term. This actually had meant that I'd ended up losing 10% of its overall value before selling out. I didn't sell out because I was worried though, I sold out because I was transferring my investments. But the crucial part of this mistake was the fact that I was investing in things that I did not understand. This happened a second time when I'd actually invested in energy stocks. I know that this gets a lot of controversy on the channel simply because many of you watching this are invested in either BP or Shell, and I did make a video slandering those stocks. However, today I'm not going to trash these stocks, but rather talk about the mistake I made by investing in them. In fact, I had no idea really how BP and Shell made their money, but I thought I did. In hindsight, my understanding was very limited in actually how BP and Shell made their money. More specifically, Shell. I knew of the process of fractional distillation, and so I knew that they had broken down crude oil into different things, such as gasoline, bitumen, and kerosene. Bitumen being road tar, kerosene being jet fuel, and gasoline being petrol. That they'd also be selling petrol to general consumers using their 44,000 branded stores. This is what they call their downstream earnings, and in their 2018 earnings report, this only took up 29.4% of their earnings. This means that I didn't know what 70.6% of the company was even making their money, and that a large majority of this, and this was only of their earnings, I didn't understand. But because I didn't understand of how bad the pandemic had hit Shell, I was simply investing in it, thinking that yes, it's dropped, it must recover, it has a great dividend yield and they won't cut it because they hadn't done so for such a long time. I expected this stock to be able to bounce back within the year, this dividend yield to be fantastic income for me, and at the time believed that yeah, they could successfully transition into renewables with ease. Don't get me wrong, this could be an excellent long-term investment, but I was very much expecting this to bounce up in the short to medium term, hence my lack of understanding in this investment. After losing about 5% of my capital and holding it for around 4.5 months, the mistake I made here was simply just not understanding my investment, and therefore it led to me having low investor sentiment and selling out. Furthermore, the idea that, yes, I only lost 5% of my capital. If we look at Shell's share price now, and I sold them at around about 1,200 pence per share, they're currently trading around 8 to 900 pence per share. That's incredibly low, and I would have lost a significant amount more. But I also lost a lot of money on the opportunity cost. This was one of my first investments in the portfolio, and I'm pretty sure I'd bought it at around April 7th. During that time period, I could have bought and gotten a lot of money from the recovery play of the other holdings that I've bought now. If I had to go back in time and tell myself something as a beginner investor, and I had to teach myself one thing to know going forward, it would be to just buy Tesla. Just kidding. I would talk about the importance of understanding every stock in my portfolio, and that you don't need to invest in every stock or every sector for diversification. Rather have a small, limited pool of stocks that you understand with a great conviction, and not worry about diversifying out into every sector, as that could also be diversification, but that's not a mistake I'm talking about today. The second mistake is something I see other people and subsequently get a lot of people asking for my view on this particular mistake. They don't realize that they are making this mistake, but it's a very common mistake, simply because someone might be wanting to invest £100. They're very new to the game, they don't have a lot of money, therefore they're trying to get the most value for their money. So what they do is they look towards stocks that are very cheap, stocks that are trading less than a pence per share. This means that their £100 can go further. They'll be buying these shares thinking, yes, there's excellent value. It's increased by 50%. It's gone from 0.2 pence to 0.3 pence in the last month. It must continue going up. And because it is costs a penny or less per share, that it would easily double in share price, and therefore I get great value on my money. However, there's usually a very good case as to why these stocks are actually this cheap. This could simply be that they are extremely unprofitable. It could also be that they are badly run businesses, businesses with high amounts of debt and terrible balance sheets, or many other ridiculous factors that I hadn't even thought of. Therefore, typically the institutional investors or the fund managers aren't actually invested in this stock. And therefore, what it does mean is that because it's got a lower market capitalization, for this example, let's assume there's only £2 million, someone with a significant amount of capital, perhaps £1 million, could push this money into the market, pushing the share price up. This could be a really big named investor, and therefore loads of other people follow that investment, think, well, if this guy's invested in this stock, I should too. They'll jump in this stock. There'll be a lot of FOMO pushing the price up, that this price has gone up, yeah, you've made money, but then this person with this high significant holding could just suddenly sell it. At which point, they'll be getting a bunch of profit, making money from you, the investor, and the share price is going to go crashing as everyone's panicking they need to sell out because it's going to drop to zero, effectively meaning that you would have got wiped out on that push upwards. This is called a pump and dump, and this happens typically with low market capitalization penny stocks, and I see it all the time. In my personal opinion, these stocks that get recommended a lot are pumps and dumps. I'm talking about stocks like SYME. I've not done a lot of research into this, so don't flame me beforehand, but to me, on paper, it does look like a pump and dump, or at least a penny stock that's very risky with a way too high valuation. This same money could be used and invested into a company worth £100 that has a consistent track record, people are consistently buying into, and day to day, they could just have a volatility of £3 to £5. This could very much mean that you're going to be getting the same relative performance on percentage, but also saving on that volatility and high risk. Furthermore, if you're able to find me a penny stock that has been listed on the London Stock Exchange or AIM market that has consistently for the last 10, 15 or even 20 years time horizon performed and given you an annual compound growth rate of 8% or more, then drop it in the comments down below. But I severely doubt it has, because these stocks over time appreciate until eventually they might be trading at £5 per share each, and at which point there's more sentiment behind them and they're no longer classed as a penny stock. The next common mistake I see is a question I get asked so many times, be it some of the comment section down below, contacting me on Twitter at Ozbourne Foreman, or even my friends, and I have a feeling I can't explain this very well, as I usually get asked the same question multiple times. On paper, it does sound like an excellent investing plan so that you can generate great returns in the stock market. However, at least to a more experienced investor, you would know this is not the case. However, some people never realize this mistake and go on to consistently doing it perhaps for years and actually underperforming the market. So to explain this mistake, I'm going to answer a frequently asked question, and that goes something like this. Why shouldn't I sell my investments at its highs and then buy it for cheaper at its lows? And yes, as I said, on paper this looks great, right? You're buying a stock at a low and then selling it at a high. That's a basic trading principle, and this is how people make so much returns or make money from, like, flipping, for instance. However, in the stock market, this is a whole different ballgame. And before looking about the kind of returns you could get, let's also look at how difficult this would be to achieve. Firstly, how are you going to know when the stock market or the price of this individual stock will peak? So therefore, how do you know when to sell? You'd either have to be some form of psychic or in possession of some heavily important insider information that no one else in the world knows. This is because the stock markets are priced in. They are priced on the risks available to this stock, their growth potential, and how it will be in the future. And in the stock market, valuations are never fair. Stocks are sometimes overvalued, sometimes undervalued, sometimes to the extreme. But it is never a fair intrinsic value, and even then it's very difficult to calculate. Furthermore, you would have to know which specific stock or indexes in which you're meant to sell or buy at those respective peaks or troughs. For example, did you really know that the stock market was going to crash due to the pandemic earlier this year? Did you know that there was going to be an oil price war? If you're saying yes, well actually I moved to cash in January, what made you do this? Was it fear? Does this mean the next potential illness, perhaps swine flu, comes along and you might think, oh god, I need to panic, I need to put my money out? More interestingly, how did you know when to put the money back in? Or are you still sat there waiting for the markets to drop? Because you see the American markets are up year to date and thinking, how is this possible? This shouldn't be true, the market must drop. I'm willing to bet that you likely didn't know this and got lucky. And perhaps you're saying, well, yeah, I could have done it. Well, investing is very, very easy in hindsight because you know exactly what happens. For example, this pandemic could have continued, but the markets might, instead of crashed, rallied 20%, but you had decided to sell. You've just missed out on that opportunity, and as it goes up, you might have been panicking, thinking, oh no, I'm missing out, so I've got to buy in now. I've just sold, I've missed out on 10% gains. As you do that, perhaps, the market could crash then and you've just missed out. It's futile trying to time the market. And if this still isn't convincing onto why timing the market is terrible, let's have a look at a fantasy story situation. And this is a group of friends that have all saved $200 per month and invested it in the S&P 500 index fund, which is the 500 big companies in the US. Tiffany, Brittany and Sarah all started investing £200 per month in 1979. However, Brittany and Tiffany were aware of big market crashes and that they were going to prepare for this. So what they did is that they wanted to buy at lows. So what they did is they put their money in a 3% savings account. That money's in there and they're going to leave that, wait for the perfect time and then buy in, getting the most value for their cash. Sarah, however, does not agree with this. She's just decided to set up her account and deposit $200 a month and forget about it. Tiffany had saved $200 a month, earning 3% interest until eventually the market crash had happened. However, she had the world's worst timing and actually bought at the peak of the market before it crashed. It is important to realise that she had never sold. In this time period, she and the others had invested $96,000 and she was rewarded just from buying and holding a cash amount of £663,000. That's quite impressive considering she had the world's worst timing on 4 of the market crashes in that time period. Like Tiffany, Brittany had also decided that she was going to save and time the market using $200 a month and putting in a 3% savings account. However, Brittany buys at the bottom and she has the best timing in the world. She has this all-knowing and all-seeing power in which she knows exactly the date to buy and put all of her cash into the market. For her time, effort, and I imagine stress, she was rewarded with a return on investment from that same $96,000 with $956,000, which, yes, is nearly more than $300,000 more than Tiffany. However, slow and steady Sarah didn't have much of an interest in the market. Instead, what she decided to do was put $200 a month into her investment account and leave and forget about it. To her surprise, when she had came back after 40 years to check on it after investing routinely every single month, she had seen that her money had grown quite considerably. The same principal, $96,000, but buying consistently every month, and she had managed to generate a return on investment of $1,386,000, which is considerably more than both Brittany and Tiffany. For example, Brittany only got $900,000. She got outperformed by slow and steady Sarah by so much. But what it does show is that if you buy and hold, you will get long-term strong performance. For example, terrible timing Tiffany still did generate a decent return on her investments. I hope that this suggests to you that the mistake here is trying to time the market, and that rather time in the market is a lot better. Therefore, if you buy consistently and hold long term, you will get strong returns on investment. However, this investigation is fairly biased, or at least this story. That's because interest rates in the 70s and 80s were much higher. However, if you're more interested in this, you'll have to go to the bottom of the source in the description down below onto the Reddit thread. Someone had done the calculations using 1-year treasury yields, and it was found out that they still underperformed Sarah. However, also, if they were able to buy and sell at omniscient, perfect timing, then sure, that person would likely outperform all three of them. However, you need an incredible amount of information to do this, and that information not even a time traveler will be able to provide without coming back with a whole massive book. The idea is that you will do a lot better than people actively trying to time the market unless they are all-knowing, all-seeing gods. If I was told with a 100% certainty from an all-knowing being when to buy, at what price, and at what day, I would likely still be very much on the fence. Unless I also knew how long I'm meant to hold it for, when to sell, and at what price, how would I be able to know when to realise these gains? Furthermore, this return on investment might be really weak, and you might only get 5% compound annual growth rate for the first 69 of 70 years. But in that last year, the share price could increase by thousands and thousands of times. At that point, I'm going to be very old. I'm either going to be dead and buried and not give a single flip about the money I have, or I'm not going to be able to see the enjoyment of that money. I personally would never be a trader. This is simply because I would not want the stress and the amount of time it takes in order to work out the perfect time when to buy or sell. But rather, I would like to buy and hold my stocks for life and just let them passively increase in the background and generating me returns. Sure, I'm not going to get rich quick, but I'm happy getting rich securely and slowly. If you're interested in my stocks to buy and hold for life, then click the card at the top right of the video. This is the Ozbourne Foreman Show. Thank you for watching. Stay safe.